So now we'll do the investing section. And if you remember from the classifications, the investing section is going to involve long-term assets. So the long-term assets that we run into on our worksheet are land, equipment, and you have accumulated depreciation that will go with the land. And we're going to be working in the investing activities section down on the bottom part of the worksheet, the statement of cash flow effects. Okay, so land, and we have to look at the notes, or they call it the additional information. Okay, so I'm going to let you look at the additional information. And we'll just do the ones that pertain to our long-term investments. And so, no equipment was sold during the year. Okay, that has to do with long-term investments. So we see that none was sold, but if we look at the beginning balance and the ending balance, we must have bought some equipment. Now, you cannot go and say, oh, you cannot just assume that the difference is equipment we bought, because if we had sold equipment, you'd have some equipment coming on and some equipment coming off. So the way it works out in this one, we can say, well, we must have bought $70,000, but that's because we've already looked at the notes and we know that we didn't sell anything. Okay, so now we made a debit entry up here to explain what happened, how we got from 200 to 270. We go down to the investing activities section and simply say what happened. We purchased some equipment. So we purchased equipment. And we made a debit up here, we make a credit down here. So working in the investing section, it's a little bit more intuitive on seeing the impact of cash. We bought some equipment, here's the equipment that we bought, and we paid out cash. This is the cash flow effect, and the credits are going to be cash out. The debits are really cash that came in, okay? Let's see, what else? Oh, land. Well, let's do the accumulated depreciation. They give us, well, they don't give us depreciation expense for the year. So we have to make the assumption that since no equipment was sold, that the difference between the beginning and the ending would be, and if we would do it, it would be the depreciation expense and the accumulated depreciation. And I've got to rework this just a little bit because we do need the operating section for this. And we need the investing section. Okay, so we've got our operating and our investing. I'm going to put back that we purchased equipment. Okay, and we purchased it for the 70, this is going to come down. Okay. All right, now we'll do the depreciation. If we were recreating the journal entry in our head, we'd be going, oh, okay, so depreciation expense, we see that the difference here is $34,000. It went from 32 plus 34 would give us 66. So the journal entry we would be recreating to get this would be depreciation expense debit, accumulated depreciation credit. Expense is an income statement account that goes in the operating section. So we are going to be going depreciation expense in the operating section because it is an expense, and that's where the 34,000 goes. Okay, so we purchased equipment, paid out some cash, that goes in the investing section. The accumulated depreciation we do along with the equipment account. We know that since nothing was sold, there's no entry here, so the entire difference must be the current depreciation expense. That goes in the operating section because it's an income statement account, and this explains the difference in the accumulated depreciation. It told us that land was sold at its cost for $25,000. So that's not too difficult. We had 100 of land. A $25,000 credit would explain the sale. And we would go down to our investing section, since it's a long-term asset, and say we sold land. And it's a debit up here, I mean a credit up here, so it would be a debit down here. Okay, so this really starts to make a little bit of sense. Depreciation expense, we know we're starting our operating section with net income, and then we're going to be making a lot of adjustments to get to the actual cash provided. So we're going to be starting with net income. We'll be adding back depreciation expense because no cash went out for that. That's just allocating cash that's already was spent when we bought the equipment a long time ago. So we add this back to get from net income to our cash. And then these are fairly straightforward. If we sell land, yeah, we get cash. And if we buy equipment, we're paying out cash. Okay, so that's our long-term asset accounts and our investing activities. And next I'll do the financing.